Been up a while then, just come out of another meeting.
Yeah, I just finished one. Happy Sunday.
Thanks so much. Yeah.
You're smiling like you've taken all the money from the market this week.
I did well. I did well on my trading this week.
Come on.
As well. So
where are we popping bottles? Where are we popping bottles? Where are we popping bottles?
I'm good. I'm at the moment. I'm working through a process at the moment where I've been developing some strategies and some stuff that I've been working on for the last 2 years.
Yeah.
3 years. And
I can't hear you too well.
1 second. Let me just check. Sometimes this mic doesn't work properly on Zoom. Just make sure. How's that?
Yeah, a bit better.
Is it a bit better? Is it not much better though?
It's much better. I can actually hear you a bit like properly now.
All right, good. If I cut out, just let me know that I'll put my headset in. But it's,
okay.
Yeah, it's just you probably heard all the lot of background noise because it was coming out of the computer as opposed to my cam.
Okay.
Yeah. So yeah, I've been working on the strategy for a little while. In terms of just understanding the markets, trading the market. So I take an approach where I'm really quite. I am quite focused in regards to the way I develop my concepts and ideas. So I take a pair, so I first started on Aussie dollar.
Yeah.
And I just traded that. Got to know and get to understand that, and then get to my trading style, get my trading style working, and then I did a lot of research, just a lot of listening to traders, to traders and their journeys to get where they are. Did a lot of work with Mark Douglas work, etc. That working on myself and developing that, and then gradually that's all been coming together. And so I took some. I've at the moment I did some work on working within set of rules. So I don't know if you've heard of a company called FTMO. I've been working in the rule set that they've got, in terms of minimizing drawdowns, keeping with. So it helps me to deal with the psychological side of things, and manage and as Mark Douglas says, you just execute your plan.
Yeah,
and that's what I've been doing. So I've been doing over the last 3 weeks. I've been getting better and better. I've been doing well. One thing that I had to work on was around the getting out, because
always getting out is always harder than getting in. When you have a plan to get in, you see what makes getting out different is when you get in with a plan. That's easy to do. You had your plan written out, your price got hit, you got in. When you get out, you have to realize that you can't decide always an exit price beforehand. You can only really decide an indicative exit price. And this is an exit price that makes sense at the time where you got in.
Yes.
It could be like you bought resistance and your exit price seems like support. However, you always need to leave yourself a bit of leeway to change your mind on exit. Because if you get new information at the time, between the time you enter a trade or an investment and the time when you exit, you can have new information that can affect that exit. And you need to then factor in that new information.
That's really interesting.
Say, you know what, the new information I have now, so let's just say your exit price is being triggered. right?
Yes.
You might say, you know what, the new information I have now kind of still supports me to exit. You might say, you know what, the news that triggered price to actually move towards my exit is long-term news, like a takeover, right?
Yeah.
You don't get out on a takeover,
Yeah.
right? Because the price is fixed. And if the deal has gone through, you're going to get that price. Getting out,
Yeah.
you're losing execution costs
Yes.
at the very least. But
Understood.
also sometimes price actually goes up
Yeah.
further
Yeah.
than the agreed takeover price because maybe there's a bidding war.
Yeah. Yeah.
So that's one scenario where if you've just robotically said, oh, this is my target entry, this is my target exit, then imagine you had a target exit on a short trade, right? Or short investment. And then this was before Corona. And then you heard that, oh, there's lockdown, there's a pandemic, right? And you're actually in the right way of the trade. You don't get out.
Yeah.
You have to realize, you have to adjust and adapt that, look, something fundamentally has happened that actually make, okay, your entry is good, but there's a new trade that could develop on from the trade you've got in.
Yeah.
If you robotically get out, you missed a trade there because you didn't know this information when you got in, but you have to use new information to drive your decision making on exit.
Yeah.
And these are these extra little bits of thought that you need to put into it sometimes. There are times, like if you're just intraday trading, where you adjust your approach again. And it's knowing how and when to adjust your approach from timing the market to time in the market. There's a time to be timing the market, but there's a time to time the market as well. I come in stock pickers from a perspective of do your best to time the market. And if it doesn't go to plan, then you're saved by time in the market. A lot of people come in with time in the market. Let me just put my budget on and wait 5 years. Well, actually put your budget on well. Do it well. Do it with strategy. Oh, there's time in the market. So you're timing the market, right? Assume that all stocks have a J curve. They start, they fall, and then they go. Right? That's going to help you with your timing strategy. Your timing strategy is not going to be foolproof, right? But having a strategy around timing is essential to supernormal returns, right? Because when it does really happen, you're going to get outperformance. You're not just going to get mediocre performance, you're going to get outperformance. And it's so, so, so important.
That's interesting.
So important.
Because that ties, what I've been doing with this is that I did quite a bit of work on looking at the stock side last week. Where I wanted to see whether any of my own methodologies and strategies for timing the market actually work on stocks.
I mean, they will. They will. Without results, I can 100% tell you that they will, but they may not work.
I was surprised how well they match up. So it's like me bringing a indices style to the entry elements of the stock, and that
I'm nodding.
At the moment, I'm sort of that's really convinced me, because I thought, my God, that makes this in terms of stock picking even better. Because we might identify the stock, but you know what? Don't go in there yet because you're at the top of that curve. Wait for that pullback. Wait for your signal. Dive in when that signal tells you now time to go. And
it won't work perfectly every time, but you know what? It will work regularly enough for you to see better returns than if you did not use that at all. And that's what it's all about. It's all about adding tweaks, adding things to your strategy that help you get a bit more profit, right?
Yeah.
And that's why I told you already that I know it's going to work.
Yeah.
Me saying I know it's going to work is not even, that's not me saying it will work every time. It's me saying with a high enough probability, you can use that signal, that timing indicator that you have for it to increase your chances of making profit overall. Because even if it works 50% of the time.
Yeah. Well, I've back tested. I've got an 80% on that on a signal entry. So
there we go.
So I'm looking at, well, now I need to know how to, I need to be able to apply it. But what I recognize is that's the sniper bit. The bit that you have to do is the spot. The other bit, which we're talking about today as well, is the spotter bit. Because, you know, what you do to be able to identify which of those stocks are worth your time to look at in regards to that. Regards to that. I did some reading as well around the value investing piece.
Yeah, you need to read that book by Howard Marks.
Yeah, I did.
He is the contrarian of contrarians.
Okay. Well, yeah, because I was pulling some stuff out, and because I always like to think about things technically as well.
Yeah.
In regards to that, because I always think if I can get some parameters, then I know there's tools that I can use in which to be able to hone things down. So then I can go and have a look at those stocks that have been honed down by either my screener or by, you know, my script or whatever. I can pull those out and have a look. So I was having a look at a couple of things, and one of, you know, I was looking at a paper that I had, about value investing, where it talked about a number of things. So your return on an equity as being a measure to have a look at for that particular stock. Your debt to equity ratio.
Yeah.
Your price earnings ratio.
Yeah.
Your price sales ratio.
Yeah.
Your price book ratio.
Yeah.
And then things like the last sort of more things a bit more floaty around the increasing sales and positive cash flows of that company, and any sustainable competitive advantage that particular company has.
Yeah, I think these are things that a lot of the time, like an equity research analyst would look at when they're analyzing a company, right? Yeah. And it's very easy to get these online. In fact, you can Google a company's share price, and if you look at the news section, there'll be robotic articles that literally already have this stuff out for the stock. We can actually try and do that now. Because one thing you can do is you can compare a price earnings ratio of a company to another company in the same industry. So comparable analysis, right? Yeah. Now, for me, I actually attach a small weight to those things.
Okay.
This, for me, just is your due diligence after I've already decided that I like a company already.
Yeah.
This is just a due diligence.
Yes.
Like, so if I like a tech company, and I like another tech company, and I'm deciding which of the two should make it in, these become the things I start to look at.
Understood.
But in general, I've come to realize that value investing, I hate to say it, is dead.
Okay.
Because we live in such a macro world.
Yes.
We are stock pickers living in a macro world. It's a macro world. Stock pickers are just living in it. Right? Times like these, there's value in stock picking.
Yes.
But ultimately, let me tell you if you think the same as everyone else, you can't get supernormal returns.
Yes. Understood.
And this is where stocks is very different to Forex, cryptos, and all like your other day trading asset classes. Let me tell you something. Every single stocks trader would say what you said. Every single stocks trader would say what you said. Right? So everyone is looking at the same numbers. So everyone is doing the same thing the textbook said you should do based on the same numbers.
Yes.
Where's your value?
Yeah.
Right? And this is why I actually attach a smaller weight to these numbers, because a lot of this stuff, I see it as already is priced in. It's priced in because the experts know these numbers.
Yeah.
And when stocks deviate away from these numbers, then they get in.
I mean, that makes perfect sense.
So then it's a case of, okay, why hasn't the price moved then if it's all priced in? Right? And that points to irrelevancy. So if you saw something like, oh, the price earnings ratio is so high, you know, like why hasn't the stock price moved? Well, everyone knows this. So everyone else has seen the same price earnings ratio. Why aren't they buying? Because it's already priced in. The stuff you read in the textbook is already priced in. But markets have this thing where prices can go abnormally low and stay there for quite a long period of time.
Yeah.
Prices can also go really high above value and stay there for an abnormally long period of time, irrationally long period of time. Doesn't make sense. That is price for you. Prices are random. The top hedge funds in the world are quantitative. They do it, they program, they make robots, right? So in their world, they model price as random particles using statistics. They model price the same way you model noise, which is also random. They model price the same way you model smoke particles. In physics, there's something called Brownian motion.
Yes,
right?
I know. Yeah.
Price is random. And the more you realize that price is random, the more you realize that price action is more important for making money in the short term, in the medium term, and quality is more important for making money in the long term.
Yeah.
Right? So my strategy goes like this. We find a company that we like in the long term, right? And everything you're saying is important for the long term, but the short term can kill off long term ideas. Right?
Yeah. Totally get that. Totally
I used to believe Tullow Oil was a long term stock. I used to
Yes.
believe companies like Barclays were long term stocks. But if you bought Barclays 5 years ago, 6 years ago, and you're doing that whole buy and hold thing for 10 years, right now you're off. You're losing money.
Yeah.
You're losing money. And by the time 10 years comes back round, you might be only flat, but probability is high that share price of Barclays won't be at £2.50.
Yeah.
It might be around £2, maybe, if you're fortunate. Or it could have a little bit of a Deutsche Bank and just start drifting lower. Death by 1,000 cuts. Right?
Yeah.
And if you look at those ratios and numbers 5 years ago for Barclays, they would have been telling you that you were happy, you were good. Probably that you'd even make another 50%.
Yeah.
So then you need to have a process that evolves. And again, risk management is king in these markets. Risk management is king, right? You should be able to make money from Barclays with a good execution strategy, even if your start price is worse, right? You got £100, you go to the market, you want to start an e-commerce business selling trainers. You buy one trainer for £10, and then you got £90. Then you go home and you be like, I probably should have just spent the whole £100 and see what I can do with it. You go back to the guy the next day, the same trainers are £1. You buy 90 trainers for £1. Now you've got 91 trainers and you spent £100. But you're still a bit annoyed that you bought one trainer for £10. The price has dropped 90%.
Yeah.
But you're a businessman.
Yeah.
All you care about is your average price.
Yeah.
And what's your average price? £1.09.
£1.09, yeah.
Yeah? you don't care at this point that you spent £10 on one trainer.
Get it.
You don't care.
Yeah.
Right? So the value investor often would just go off and would have bought Barclays at £2.50. Everything was ticking. Everything looked rosy. Probably a target exit price of £3.50. Right? Probably did it in size as well. Barclays also maybe paying a dividend. He probably thought, what could go wrong? It's a bank, British bank, survived Lehman. We're in good times. Like, what could really go wrong? Interest rates are popping. Everything is popping, right? The trainer guy, that's like buying 10 trainers for £10 each for £100. And then the price drops 90% and you can't do anything. You can't buy more because you didn't put enough cash reserve to buy more.
Got you.
The modern day investor cares about the average price. That's what matters. And if your average price is even close enough to market price, you're good, right? Someone who bought Barclays at £2.50 and then saw Barclays share price at 80 pence and bought more, exactly the same size, right? Let's say it's $1 million, 2 ways. That's 2 million that they've spent. One at a price of £2.50 and another at a price of 80 pence. Okay, these are big numbers. So you know what I'm going to do? I'm going to make the numbers a bit smaller. So £1,000, £1,000 divided by £2.50 is 400 shares. And then the price dropped to 80 pence. You spent another £1,000. You got 1,250 shares. That means in total, he spent £2,000 and he's got 1,650 shares. Each share, guess how much it cost him? £1.21.
Yeah, 121. So then he only needs
Guess what the price of Barclays is right now?
Go on.
£1.31.
Right. Yeah.
Right? Buying a bad price, you can strategize.
Got you. Yeah. No, I see exactly what you mean. You know, as he said, people panic. I've got to get out. When actually,
I really
buying it at the cheap price, then as you said, the average then balances itself out to the point actually you're making money. That erodes the loss that you have holding on the other shares.
And the question a lot of people are going to be asking is, how do you know when to average? How do you know when? The thing is, right? You can set this plan up. You can write a plan up already before you even buy it at £2.50. You take emotion out your head. And you've already written this.
Yeah.
How do you know the levels?
Yeah.
That's a challenge.
Yeah. And that's interesting because that was one of the things I was going to ask you about the watch list. Just the watch list first, because I noticed in there you put prices of where you expected to be able to have gone into added, etc.
Yeah.
So, in terms of that, was that a technical view? In regards to where you wanted it to get to before you went in?
Yeah. Some of it's experience. Some of it is looking at the charts. Some of it is a combination of both. One thing I know is that you eliminate risk if you buy on sale.
Yeah.
That is a very, very, very basic concept where you don't need to know anything about the stock.
Absolutely.
Right?
I mean, I do that on the on trading FX.
That's just business, right? Buy things on sale, right? Wholesale prices, not market prices.
Yeah.
I like to buy on sale.
Yeah.
So when I put a price in, sometimes I have not done any analysis whatsoever. But I've said, you know what? I don't like this industry. don't like this company. Let me just put a price in. If it starts, if it's able to get to that price, then I will look at it.
Then you've got my interest.
Then you've got my interest. Once it's alerting and it's got my interest, I'm going to know that prices come from a high place to even be alerting in the first place.
We're near that. Got you.
Then I do my analysis.
Yeah.
But I'm not going to waste my time doing analysis today. Yeah. Why? Because I know I'm not buying today at this price when I've looked at the chart and I've seen that we're 5-year highs.
Yeah.
So a lot of stuff on the watches are just sitting ducks.
Yeah.
They just quietly just there.
Yeah.
I don't have any strong view, weak view, but I know that when I looked at it and added it to the watch list, it was like face value, no.
Mm-hmm.
Without any analysis, no.
Mm-hmm.
But you know what? If it can get to this price, we can have a conversation.
Mm-hmm.
We can have a little conversation and a little bit of we can dig into it a bit more.
Yeah.
Because on a long-term chart, it could just be something as simple as a record low. It could be something like a 1-year low, right? If it can get to its 1-year low, I would like to have a look at that one.
Right.
Because I actually like the industry. I just don't like the price. There can be better out there, right? Did we talk about Dragon's Den the last time?
About?
Dragon's Den. I don't think we did.
No, it doesn't.
Okay. So, do you watch the show?
I used to follow it a lot beforehand until the guys started to teach people out.
When was the last time, tell me, when was the last time you saw, or how regularly do you remember seeing a business get the investment? Was it regular?
No.
I remember it's like trying to wait for someone to win $1 million in Who Wants to Be a Millionaire?
Yeah. Because people were saying, well, no to that when they were pushing that down to certain levels. I think it was only really just after My Man Roots that you used to get a lot of yes, and then for some reason it was a lot harder in that respect. And maybe that's because people were coming in with a higher price mentality to say that rather than what the dragons thought, actually, no, I'm going to put it down.
Dragons have a high bar. Sometimes because the dragons actually have a high bar, they see value. They only buy on sale. They only invest on sale.
So, yeah.
So they're saying, you know what? I'm only going to invest if I get at a sale, right? Some may look at it as harsh. Some may look at it as stingy. But the bottom line is, they know that every business like that has high risk. They might not get their money back.
Yeah.
And that's why they price it in that kind of way.
Yeah.
So the key thing here is you're a dragon.
Mm.
Tony, you are a dragon.
Mm-hmm.
Stocks, they are pitching to you.
Yes.
And what we can learn from Dragons Den is you need to be picky. That eliminates risk. So already you can see, like, without being too technical, and this is why my blueprint works for total beginners. I can eliminate risk just by 2 rules. Only buy on sale. Actually, 3 rules. Only buy on sale. Be like a dragon. Be picky. And number 3, use your network. Those 3 principles alone, do you know how much risk you eliminate? When you just tell the group, oh, by the way, I'm looking at this stock. If someone else is looking at that stock and has some news article or has some information that can contribute to your decision making, I'll add a 4th, use your mentor, right? Or better still, have a plan, an execution plan, average. Don't just buy your full budget. Those 4 things alone, without knowing anything about any stock, without being an equity analyst, has already increased your probability of being successful. Even if you invested in a bad stock. So imagine if you invested in a good stock. If things start to go bad, That's opportunity
Mm.
to buy more,
Mm.
because long run, you believe in this stock. A stock like a PayPal, a stock like a Shopify, companies you know, without opening the books to see if the company directors are buying, without checking the price over earnings ratio, without checking if they've got cash flow increases. Look around you. What do you use? Everything you pay for online often has a PayPal option. You don't need to be some research. The analysis is actually just confirming probably what you already know without looking. I'm not saying the analysis is bad, you shouldn't do it, but it's a good confirmation rather than a direction to buy. I use those things as a confirmation. And sometimes I just say, you know what, we're not in an environment where price over earnings ratio is important. Right? So many stocks are, you know, on a price over earnings ratio thing. Technically, Snapchat doesn't even return a profit. Uber doesn't return, they're still a loss-making business. Right? So why am I going to look at their cash? I already knew this. I already knew this. The cash flow is just going to tell me what I already know. Right? It's important. It's useful maybe to see how it's changing. But the bottom line is, Snapchat isn't going bust. Someone will buy them. That might sound a bit too overconfident, right? But there's certain companies in the world that are important for the future.
I can see I get that one definitely, because it makes no sense that that's going to go anywhere else, because the money is in the contact information that you've got, the audience that they've got, rather than thinking it's it's anything else. It's the audience, isn't it?
Okay.
So I like that. I mean, that makes absolute sense.
How are you finding the averaging? Let's get you making money in stocks.
And I like that idea. I was talking about that. I was looking when I was going through the chat. I mean, sometimes you just turn your head, and before you know, you got 80.
Yeah.
I mean, you know.
But that's what I'm here for. You see, I don't miss anything in the chat. That's my job. Because I'm earning from this now. It's my job to keep on top of the chat. Why? Because I've got mentees, and they might see something in the chat and ask me a question. So I need to be on top of the chat, right? Everyone doesn't need to be on top of the chat. I don't miss a message. I'm dyslexic, so I know how to scan. I've learned the art of just scanning through stuff and filtering out what's important. It's funny because I had a session with someone, and I knew the price they bought a stock at. They didn't remember. I remembered. I'm good at keeping a mental note of this kind of stuff. Because I'm looking out for my people as well.
Got you.
So then, if you know that I'm following the chat, it's easy because I can just, you can ask questions. If there's anything you missed, or
I'll do that. I definitely do that. Do you always add it into the watch list if there's something you picked up? Not always.
No. The thing is, I out of everyone know the composition of the chat more. Because I'll probably know most people in the chat. Not most people in the chat. I'll probably know more people in the chat than anyone else.
Understand.
The Telegram chat is almost like 50% now. The ratio is changing as the numbers grow. So I know the people talking, or I would have been following the people talking.
The key people.
Even if I don't know them, to know, whether they're beginners. Sometimes I'll send messages to some of them, just have a quick chat, just so I know, are you new, are you experienced? So I can filter out what is coming from a beginner, what is coming out from a novice, what is coming from an experienced investor. That's my job from following the chat.
Got you.
Now, beginners had a lot of value. Just by talking about trends. And this trends for me, like I always say, is far more important than hearing about the quality of a company. because a good quality company can make you maybe 15%. The company share price might not even go down. There's a company called JD.com, Activision Blizzard.
Yeah.
These companies have, I don't think they're going down, but over the past year, they've gone up.
Yeah.
They've only gone up like 50, 30, 40%, which is okay. These are not numbers to be found on. But in that time, I've done other companies, in, out, 70%, 80%. So sometimes there's something called opportunity cost of time compared to the return. So sometimes it might be better to just do a quick Aston Martin position. I call it the BRB, be right back. I liquidate if I see an opportunity, I do that opportunity, and then I just come back in, and I still realize that 6 months later I can still get the same price. Rather than just sitting on that capital in that position. So if I notice some price action, like some price action, that the price has just been stable at a certain level for a long period of time, then I can do that. And just hope that in that 3-week period, there isn't anything crazy that happens. And usually there isn't. Maybe I might buy $1 more expensive, but usually there isn't. So this is another little concept that's quite interesting as well.
Yeah, that's interesting. I mean, it's interesting as well that, like you said, you don't need to put everything on there in regards to.
No, I filter what gets on. I'm very. Do you know what? Since Novasit, so Novasit was one of the Corona stocks. The amount of stocks that I made it onto the watch list. I think before Novasit, for the whole year, I had 150 stocks. Since Novasit, I've added another 100 in the past 2 months, 2-3 months. The list, the watch list has almost doubled. Corona.
How do you filter that though?
Sorry?
How do you filter that? Because that ends up being quite a lot to manage.
Some names are going to start coming off.
Yeah, you start taking things off now.
Some names will start coming off. But then I looked at it a different way and said, you know what? It's actually better to just keep going till I have 15,000 if I have to, right? And just find ways to automate and improve. It could be that they're going to be 6 watch lists. One for each country. Right? Or one for one for Europe, one for US, one for ETFs and funds, and one for the UK.
That's interesting. That makes sense.
Right? So then people can go into whichever watch list they want. But then if it starts becoming a bit of a chore for people to go into watch lists, that's my job. Right? But I would split out all the watch lists. And I might then, within each watch list, have tabs and say, okay, these are the high risk, medium risk, low risk. So people can understand. Instead of me saying large cap, small cap, medium cap stocks. Right? High risk, medium risk, low risk for each country. 6 different watch lists. Right? And people just then need to go into each watch list every day. Right? But then what I would also do to make my life easier is, if I don't have the time to be going through every single watch list, and it does eventually start getting operational, right? I'll tell people, like, if you want something added to the watch list, open the watch list and put it in a comment. So all I do at the end of each day, close a business, I'll go to every watch list and see the comments that people have been adding, and I'll add it to the watch list. And I'll find a way to automate that. Rather than just like, and then I'll have my own personal watch list from that, because it's just going to be too big. So what I'll do is, in my own personal sheet, I would have my names from all of the 6 watch lists, my top 25 names that I'm looking at. And if people find this too operational to keep opening watch lists, that's fine, because a watch list then becomes some sort of database. And then on the front end, I'll start adding it in the newsletter. My top 25 names from all the watch lists combined. And people might just focus on that. I'll send a newsletter with what is alerting on all the different watch lists. These are the names that are alerting. These are the strategies that I use to average if I was to get into each one. So I feel like I rather it goes that way than to take names off and then I never look at that name again.
Understood.
Let's face it, the only names I ever look at are the names on the watch list, and it's
Yeah.
sufficient for me.
Yeah. I've got a question in regards to swings of stocks. This is something that's quite new to me
What's
in
that?
terms of the swing of a stock, you know, the gapping,
Okay.
where price will suddenly just gap.
Okay.
Or I've noticed
I'll
on,
explain that to you.
sorry?
I'll explain that to you.
Okay. And the other one is where you suddenly see one long candle and then suddenly retraces back up or something like that. So, you know.
Are those things you usually wouldn't necessarily see in?
I wouldn't normally see that. No. So
Okay.
you won't see.
So now you need to understand that the stock market is a different ball game to all the rest.
Yeah.
Because the volumes in the order book are very different.
Yeah.
In Forex, you get maybe 1 lot, 2 lot, 3 lot at each price on the order book because it's just so volatile.
Yes.
In stocks, you can get 1,000 on each side. So then, let me explain this analogy to you. There's a queue. One person on the left, one person on the right. A two column queue, right? The people on the right are buyers. The people on the left are sellers. So the people on the left are saying, look, I've got inventory to sell. The people on the right are saying, I've got money. I can buy from you at this price. Yeah, just like, you know, your order book. And each one's got volume. And you come and you've got 2 clients. One of them wants to buy 500 oranges from you today, and one of them wants to sell 500 oranges to you. But to sell. You're just their you're a runner. You're their runner. So you're going with 2 orders. One is to sell 500 oranges. The other is to buy 500 oranges. Right? 2 different people you're doing it for, and you earn a commission. Right? You're a broker. So what you do is you go to the exchange, the queue, and you know that the people at the front are the ones with the best price. So the people at the front of the buy queue, they're buying at the highest possible price, which doesn't make sense, but it's good for you. But they should get filled first, because I mean, it's a seller's dream.
Yeah.
And the people on the other side who are selling, they'll sell to you at the lowest possible price, which is great for you because you're buying from them. So it's like sorting cheapest, lowest, lowest to highest, and then on the other queue you're sorting highest price to lowest because you're selling.
Yeah.
Now imagine every time you buy the volume or you sell to the volume that someone was looking for, they leave the queue. Or let's just say like the 2 people in the front of the queue have 1,000. 1,000 to buy, 1,000 to sell. You're done. The queue didn't move. The queue didn't change. Then someone else comes in. Eventually they do the 1,000 and then goes to the next price. Or instead of after your order, they say, you know what? Whoa, half my inventory gone by one person. Maybe I'm doing something wrong. Let me go to the back. And at the back, their prices are nicer, but it just takes, you need a price to move there before they get filled. The reason you see gaps, people start leaving the queue. So imagine like you've got 500, they know you, they see every day, Tony, big baller, Bernanke Tony, right? So every time you actually come, they see how quickly you're buying. And they're like, you know what, this guy's got money, you know, this guy's got bread. Let me go back, and then what happens is a knock-on effect. A lot of people start leaving the queue. It could be another reason. Maybe the stock is going to report earnings. People leave the queue, like what I explained the last time.
Yeah. That was so useful, that as well.
Yeah.
Understood that. did give me some insight for the other stuff that I was doing.
That's basically what you're saying.
Yeah.
People leave the queue, come back. But
yeah.
it's not just news, you see.
Yeah.
It's the quality of stock. This is what maybe what I didn't explain the last time, because I just explained it in terms of data and news.
Yeah.
For, let's just say it's oranges, right? The queue for oranges is going to look very different for the queue for figs.
Mm.
The queue for figs is already going to start off thin. In fact, there might be some prices where there's no one there.
Yeah.
So they're gaps. So as long as one person buys at each price, you're going to see the candle move, and then it'll come back. Ah, I'm back.
Back in. Yeah.
Oh, I don't know where this laptop.
Yeah, I was just saying that that makes sense. So you suddenly, let's say you are heavily weighted in that price of your portfolio will drop for a second and then shoot all the way back up again.
Yeah.
In terms
I've noticed this as well, because I looked at the candles on IG, and I noticed sometimes I see some weird. It's just because the market mechanism for stocks is just more. It's just more, especially for smaller companies.
Especially for that.
Yeah. It's it's just different.
Yeah.
So that's why sometimes I actually, you know, that phrase, technical analysis doesn't work for stocks.
Yeah.
There's a reason. There's a reason.
Yeah.
It's not completely correct, but that's what they're referring to.
Yeah.
You get a lot of false negatives.
Yeah. And I think that
some aspects do work, like timing. Those will always work. You could be trading pigs.
Yeah. I think where I really seen that is that I'm particularly, I've got so much better at my longer term target structures, and that means therefore you're looking at more quantity because you're stepping away from that, so you get less variation, if you see me, because you're looking at a daily. I usually go on a daily. I can identify based on my structure where I think that price is going to go, and so and that's why I'm trading that with Dow even at this moment in time. I know I've got my target at 28,900, whatever. I therefore trade up everything in that direction because that's my target that I know.
Yeah.
So I've been looking at that to see whether I can apply that to stocks, so that from not from the close up, but from the sandback, whether I can give myself a target element, and then, as you were saying, when you then go down into the depths of it, especially when you've got these little mad movements, you're not worried about that because you're thinking overall that's where I'm going.
Yeah.
That up and down is just as you said, people coming in and out of the market, but my long-term view is this target.
Do you know what else you can do? Apply it to stock indices, because indices.
Okay.
And this is where beta comes in.
Yes.
Remember we spoke about beta.
Yes. Yeah.
If you can apply your macro signals and your macro way of thinking to stock indices, then when you're making decisions about beta.
Yes.
So if you feel, this is where some of the guys who are macro in the chat, some guys only trade indices.
Yeah.
So if they see a really strong signal on the stock indices.
Yes. That's interesting.
You can use that in your single stock decision making because you know what a stock's beta is.
Yes.
So if a stock has a beta of 1 and above, then you know, okay, with a decent probability, the macro guys are saying stock indices are going to sell off.
Yes.
Then you might say, you know what, I'm not going to buy this stock now.
Yeah.
Because that stock index sell off that technicals are kind of showing, which tend to work with stock indices, is telling me that I might be able to get better.
Got you.
Or you're at your profit taking point, even more reason to sell. But if they're saying actually stock indices could rise and you know the stock's got a decent beta, you might get another little 10%.
Yeah.
You wait a couple of days.
On the stock indices, is that split How are those built up? Are they built up based on, let's say, whatever fund decides what they want this percentage split to be?
No, so the
How
FTSE 100, for example, is the top 100 companies in the UK by market cap.
I'm with you. Sorry, that's what you mean by stock indices. Sorry, sorry. I thought you would. So my apologies. I was thinking whether you were talking about like an ETF or something like specific.
No. I mean
Right.
just like your major indices.
Yeah.
FTSE 100,
Sure.
your DAX, S&P 500, Dow Jones.
Sure.
Those are the key ones, because the beta refers to the sensitivity of the stock, like Vodafone, to the index that it's a part of, the most major index that it's a part of, like your FTSE 100.
Yeah.
If you look at a beta of like a gold ETF, it would actually compare it to the S&P 500 beta.
Yeah.
And price. Oil as well. They compare it to S&P 500.
Yeah.
And calculate the beta. But general, like a UK company will be to the FTSE 100.
Yeah, that's interesting.
German company to the DAX. But then beta doesn't become more. You can't really use beta when you start looking at. There's a point where you kind of ignore beta a bit more, especially when you start looking at small caps.
Yeah, sure.
Because there are other factors that are more important than beta.
Yeah.
But for your main companies, your big companies, beta is quite important.
Yeah. Do you have a you said small cap? Do you have a cap that you?
I just look at the index.
So you don't worry about what's the size of cap is for a company at all. You don't have.
No, I mean, for me, for UK companies, for example, FTSE 100, then the next 250, FTSE 250, and then
FTSE. To really split them out and keep. So you wouldn't do anything that was not in the FTSE at all.
Maybe I do have the punting gene. So the way I do it is if my portfolio is up, I'm a trader, right?
Yeah.
If my portfolio is up, these are my conditions for punting. My portfolio needs to be up, and I only punt with a portion of my profits, and I still do the whole averaging thing.
Yeah.
So I might take $1,000 and just go 300, 300, 400 on a punt.
Got you.
But only if I'm up.
Yeah.
Like maybe 6, 7, 8 grand in a year.
Yeah.
Then I know that I've got 1, 2 grand to play around with.
Yeah.
And sometimes I've been able to leverage that. That's how I was able to take advantage of some of the Corona stocks. The first one made me 600. That was Gene Drive. And then I know I've got 600. And then I did Aston Martin. That made another 350. That's already $1,000.
Yeah.
Then I did Omega Diagnostics. I made about £400. Yeah. So I've got I've already made profits with my risky trades that made profit.
Yeah.
So then it's like, now I know that I've got 1.5 grand that I can play with. But I've also done other things.
Yeah, play money because you won that on the spin, basically. Took that punt on that.
And then I've unwound stocks like Alio Gold, which I had on at 88%.
Yeah. Yeah, that's an interesting one as well. Actually, I'm having I'm really interested in a number of the silver stocks, so I'm having a look at that at the moment as well. So I've been doing some research.
There's one that's getting added to the FTSE. I think it's called Fresilo. It's being promoted to the FTSE 100.
The trouble is that I in fact I had Fresilo up on my. In fact,
I don't like the price, right?
I've got it right now at the moment. The problem is that on the structure that I have.
There's no entry.
No, this is breaking down first. I'm looking for this to break down. At this structure here, we could break down to. I mean, the last low.
And this is where things are. This is where things get a little bit important to look at things in a different way.
Yeah.
So when this one gets to FTSE 100, it's going to find a completely new pricing range.
Yes.
So you can't use the old pricing. You can't use the old charts. They become a bit less relevant.
Did you say this has moved to 100?
Not yet, but it's being promoted by market cap, remember? It's knocking on the door for promotion.
Right, okay. They just did a reallocation, didn't they?
Oh, it might already have happened.
I think that they've just done they're just doing a promotion.
Rebalancing.
A rebalance. That's it. Yeah.
I can't remember if it's actually happened yet or not. But what I do know is, and I need to calculate what price made Fresnillo eligible. There was a price that made their market cap maybe enough for them to get promoted to the FTSE 100. And I just need to figure out what price that was. And for me, that's going to be like a key level in terms of a floor, a good buy level.
Yeah.
I haven't done the analysis yet.
I'm just having a look. I'm just having a look to see if I could see if they shown the companies that were right. I can see the March review is here. Let's have a look. Just open this one up. So,
but you know what's interesting? Fresnillo.
Yes, it's exiting the 250. Yeah, it's definitely exiting the 250. The changes were, what is this 4th of March press release? And Fresnillo are definitely exiting the 250, and so that means they're going up.
They only came out in December. Can you believe that?
Yeah, that's crazy. Fresnillo, Intermediate Capital Group, and Pennon Group have gone to the FTSE 100 in regards to that. So that's interesting, like you said, in regards to that, because if that's just done that, looking at it on the daily, they've got earnings, they've got an earning estimate in 28th of July. So they will come up on my dividend fishing list. Those ones. They announced their dividend gross at £9.58, 9.58.
Okay.
That's quite interesting. But at the moment, based on the structure of what I have at the moment, because they've been in a bit of a downtrend for since about 2017, 2018, 2019. So now this is quite interesting. Their cap is increased that much, even on a downtrend, to get themselves into the FTSE 100. I'm looking at this. I can see that there is an opportunity, but it's not going to be for a few days yet. I think what we're going to see is a drop first in regards to that coming to the especially when it comes down to earnings.
Yeah.
Because what I know, with the dividend fishing stuff, I've been reinvestigating that, actually found some of my old stuff as well, which has been fantastic. That's why I was talking to one of the chaps about oh God, what's the name of the company? Seven, and there's another one as well. And 3i Group as well. And 3i Group as well. And so their dividends are firing this week in regards to that. But you've got to be able to make it worthwhile. You've got to take that as a shot. You've got to be in there early. Yeah. So and I calculated that out based on what was that one? Based on 800 shares.
I definitely need to do a bit of digging, because I know that the level for the FTSE 250 is about £500 million.
Okay.
And some stocks, they go in and out, in and out. Fresnillo left the FTSE 100 in December, and now it's knocking on the door to come back in again. I need to remember what the level was.
I'm with you. Sorry. So they were in the 100.
They came out 100, and they're knocking on the door again.
Yeah, got you. So that, in some respects, is almost turning around. I mean, I'm looking at the structure now. This is the actual, the bottom. We're hitting the bottom and turning back up now. Because looking at that, where it touched that price, I would agree with you. I think that there is some upward move on that. And now, obviously, I've been following it through some other channels in regards to gold and silver bugs, and they're looking at a long-term play on this particular one. But that's useful information, because I didn't know that. That it came from. if I have a look at their 30-minute chart, right? Yeah, so I can see at the moment clearly there's a drop on the 30-minute chart. I'm going to put this on my list. I think it will come down to about 660 to retest this to try and get a better price.
Yeah,
there's a better price. It jumped up, it's coming back down, and then we just wait for a daily signal. If we can get a daily signal, then I'll just say technically.
You know what I'm going to try and do? I'm going to add to the watch list the market cap. I think it might already be there.
Yes, it is.
I just ignore it. So what I'm going to do is I'm going to get the market cap, and then I'm going to set the thresholds for each of the major indices, and I'm going to set up a new alert. The new alert is if something is getting close to the market cap or being part of a new index or not.
Yeah. Is that done every quarter? So you can move in and out in a quarter?
Yeah.
Right, I'm with you.
I can't remember the exact criteria. I think they look at the average price over 90 days.
Okay.
And use that to calculate it.
That's very interesting.
I've got to jump off now.
Oh gosh, all right. It's time already. Okay. No worries. Thanks very much for that.
But you can always just message me, like, if you are looking to use the spreadsheet to put a new position on, and I can give another eye to it. Yeah. And then you can combine it with your signals.
Yeah. Definitely. I'm definitely looking at all of that. But by the way,
you can hit me up before any time you do a transaction on HL, right?
Yeah. Like I said, I've opened that account. I've actually opened a trading 212 as well.
Okay.
So I've got both of those accounts. I went through and had a look at, and I found one of my small pension plans.
Yeah.
In regards to that, with Prudential, I'm coming back to that. I've already come back to them already because I'm going to basically cash it. It's like 20 grand. That's in that particular one.
Put it in a SIP.
That's what I thought. I'm going to take it straight out bring it into
HL.
Put it into HL. I'm going to talk to you about the SIP.
And put it all on black.
and put it in there, and obviously I want to do the shares as well.
Yeah.
Build the shares and long-term shares as well. So, but yeah, look, brilliant as per usual. Really, really useful. We'll keep doing, because I think it's really useful having this conversation, and I learn so much all the time. But I'm really glad about this because I can see that there are elements of what I do that fit what we're doing here. And I
don't like to admit it, but I think I found my niche.
Yeah, no. Look,
what I mean by that is consistency. Consistency.
Yes. We need, and that's the key thing we need, in regards to that.
Size will come later.
Yeah, and like I was doing last week, I one of the things I have learned is that, especially when I do my indices and that, I'm good at scaling in. So So I'm good at scaling in. I can take I'll take a small account, £500, and I'll make it £2,000 because I can scale in. And understanding that logic of doing that. And so what I'm looking at is the ability to be able to bring that to the stocks.
Yeah.
So especially when we go for long-term ones, in terms of looking at the right targeting, looking at the right pullback, right, get back in, get another 1,000 shares there. Right, okay, where's the target of that? Get another, take some off, you put some in the bank, go for it again, however we need to be able to do it. But I think overall, there's a lot of talk at the moment in where the market's going, and it's already broken through the 61.8 on the Dow. It's now at the 78.3 in terms of that. I've got a target of 24,990 in regards to my upper target. We may just go straight flying past the last high.
Yeah, I think I said something. I said, look, we can actually hit 30,000 Dow. New record high again.
Definitely. I've got trades on from, I can't remember where, 22 or something, where I've just left them. I said, I've just left it because I said we're not coming back here for a long time. I might as well just leave it in terms of that. And I think we will break I think my targeting is telling me we're going to hit that. At that particular point, I'll then reassess to see whether we are going to keep going in terms of that. We keep going. I was reading a guy 6 months to a year ago who's talking about 33,000 down in regards to that. So,
wow.
But yeah, I mean, that's my side in terms of, that's my specialism in regards to what I've done as well. So any thoughts or anything like that you need to know on that?
You don't need to ask me twice.
Just shout me. I love discussing it. But look, you got another call. I'm going to let you get off and get that done.
You take care and have a good Sunday, Tony.
Thanks. All the best now.
All right, take care. Bye.